Well, good morning, folks. My name is John Needham. I'll be your host for today's Danielcode report, which is for Sunday the 8th of March. We've got, today we're going to talk about Forex, we're going to talk about GLD, the gold tracking stock. We're also going to talk about the major US stock indices, which are quite important. These charts are available at the Danielcode website, www.thedanielcode.com. They're also available in the link to the right of this video on YouTube, so please print out the chart so you can follow along with what I'm talking about. The first chart we're going to look at, chart number 1, is a chart of the GBPUSD Forex cross. During our recent free trial, we had a number of people who didn't seem to be able to get a handle on these TO3 signals, one of whom was Duncan, who wrote to tell me that he thought this was a losing trade. Now, we have a wide range of people who use the Danielcode. We have some of the biggest broking firms in the world trading off these numbers and signals. We have a large number of proprietary traders. We have some very big private traders, and we also have a lot of part-time traders. This is to whom this remark at least is addressed, that you do need to put these charts in context. I've put in the introduction to the T3 signals that these are fast signals. They come off a daily chart. They may be something as insignificant as a one-day counter trend or a part-day counter trend, or they may be something as important as the start of a major trend change. You need to qualify that. So let's looking at chart 1. That just shows you where those T3 signals are. You can see how they picked the counter trend on the 13th of February. The next one gave us the low of the move. 3 days up, we got the sell signal, and then 4 days down. So you can see how beautifully they work. Moving on to chart 2, looking now at qualifying this signal for the 13th of February. If you look at the slow stochastic, which is our overall trend indicator, you can see that the stochastic's right in the middle of nowhere. It's nowhere near being oversold, so we were not looking for this to be a major trend change. That's telling you that it is likely to be a one-day counter trend or maybe a 2-day counter trend. In chart 3, we've put on the fast stochastic, which is what you would use to qualify this as well, and you'll see that on the faster stochastic, that's the 533 stochastic, we are oversold, and that's part of what set up this TO3 buy signal. Chart number 4, you can see there that I've put in where you would have bought this market if you'd been trading just off the daily charts. That's if you guys happen to be part-time traders, and you'd have bought at the previous day's high, 14420, plus 6 ticks above the previous day's high is where you would have bought the T3 on the daily. Now, there was 183 ticks profit in this trade, or some part of it, just on the daily entry. So that's about 9% on margin. That's a very, very significant trade. And you must move your stops to protect profits. If you're part-time traders and you can't watch the markets during the day, you must use a trailing stop of some sort to protect profits. If you move on now to chart number 5, I'm showing you there a better entry for those of you that are able to trade full-time. And all we've done here, we're looking at a 240-minute chart. We don't need to go down to any faster time frames. I never do, but you're welcome to if you want to. You'll certainly get in earlier and you'll certainly have more false signals. But just looking at chart number 5 on the 4-hour chart, I've shown you there which bar gave the first positive cross on the fast stochastic. That's the 533 stochastic. You would have bought at the high of that bar plus a few ticks. That order wasn't filled, so then you got the next bar completed. That's shown as still positive on the stock by 2 ticks above this bar, which would have got you into the trade at 14279. The trade went straight up, couldn't have been any easier, to 14603, so there's some part of 324 ticks profit in this trade, which is $3,240 on an average of about $10 a tick. That's about 162% on margin. So depending on your stance and your trading methodology, you got some part of that. I'm not saying you got it all, but it was a very, very handsome trade. If you got somewhere near it, you got over 150% on margin. Now that is a fantastic trade. If you weren't able to see how that could have been a profitable trade to you, please go and read the T3 material again, look at the videos, because you're missing something very important. And many of the signals that you wrote to me about, Duncan, fall into the same category. When they are set up to be counter trends, you've got to protect profits. If you're looking for longer term trades, Don't take the ones where they're in the middle of the stochastic. Wait for the slow stochastic to get overbought or oversold if you're looking for more of the swing trading type of thing. Our next chart, chart number 6, is COMEX Gold. I wanted to show you here the TO3 sell and buy and sell signals. Murphy's Law, of course, struck, and while we were having our free trial, we didn't get a successful signal in the TO3s. We just got continuations of the buys. But you can see from here that the first sell signal on this chart was elected at 9.76. That's Monday's low if you were just trading off the daily chart. Thursday's low before we got the outside bar reversal was 9.46. So there's some part of $3,000 per contract profit in there for you. And if you took the 240-minute entry off the stochastic exactly as I've just shown you in the Forex, then there was about $4,000 per contract down to Thursday's low. On the Friday we had a TO3 buy signal, and same thing here exactly as I've just shown you. Have a look at the slow stochastic. You can see that that TO3 signal came when the stochastic was in no man's land, the slow stochastic. That tells you that the probabilities are you're going to get a counter trend. It might be half a day, it might be 1 day, it might be 2 days, but you need to be much more aggressive on your stops to protect profits, or at the very best to get to break even and not have losses. So the market then went down another $40 down at the low. We got the buy signal last week, as you can see from that chart, and it's rallied about $28 since then. So we've had every move in gold has been just about perfect for us. Outside days are always a disaster for traders. You have to be fairly nimble there, but if you had positioned yourself to be aware that it was likely to be a counter trend, you shouldn't have got hurt. Chart 7 is gold, GLD. This is the tracking stock for COMEX Gold. A lot of our clients have asked for us to start introducing coverage of this market, which I'm going to do in about 2 weeks. I just want to draw your attention to 2 things on chart number 7. First of all, this market is very gappy, and that's because it only trades during normal floor trading hours at the New York Stock Exchange. Those gaps have to be allowed for. They are part of the price pattern. So when you have a gap, and today's high, for example, is below yesterday's close, the true high is yesterday's close because the market had to travel from there to make today's bar. So be very careful trading GLD. If you're looking for daily elections of the T3 signals, you have to allow for those gaps. Looking at chart 7 further, you'll see that the T3 signals on GLD are exactly the same as they are on COMEX Gold. Occasionally we do get a subtle signal on GLD that we don't get on COMEX Gold, so I think this is going to enhance the coverage that I give you. Bearing in mind that there's very high degrees of correlation between all of these precious metals that we cover, Huey gold, silver, and starting in a fortnight GLD. And a signal in one, if it is elected, is very likely to trigger a signal in the other market. So if you get a TO3 signal in COMEX Gold and it is elected, it will almost certainly be also elected in GLD and vice versa. So be aware of that. Final thing I want to share with you today, chart 8, is the US market indices. Now on Friday, the unemployment number was about what they expected, 652,000, a truly appalling number. And both the Dow and the S&P managed to close slightly higher. So we're starting to see, I think, markets discounting the bad news of unemployment. I mean, there'll be plenty more bad news to come. I think we're probably only in leg 1 down, and it's going to be a 3-leg affair as they most are. But for the time being, we're terribly oversold. We're very overdue for a bear market rally. We're starting to see the market discounting bad news, and for this chart I just wanted to give you something to think about, that the little R, letter R in the diamonds at the bottom in blue on that chart are where the futures contract rolled over. Now if you just scan that, you'll see that where contracts roll over in equities, it is very likely to be a trend change. You can often get trend changes there. Nothing in this tells us the quantum of the change. It may be a major change, it may only be a matter of a weekly counter trend. But I think it's a good time to say to you that you should be on heightened awareness, in the next 10 days for at least a medium-term bottom in the US equity markets and a counter trend, and if that happens you won't want to miss it. I hope you've enjoyed this, and I hope that you take the opportunity to be aware of the wonderful world of trading that awaits you.